I'm Charlotte McLeod with the Investing News Network, and here today with me is Nick Barisheff, President and CEO of BMG Group and author of $10,000 Gold. Nick, thank you so much for being here online with me today.
You're welcome. My pleasure.
Great. So, since it's our first time speaking, I wondered if you could tell me just a little bit about yourself and the kinds of things that you do at BMG Group.
Well, it's been a long time. I started the company in 1998, and we have three mutual funds. One is a gold, silver, platinum fund. Another one is a gold only, and another one is a silver only fund. And we also have a product line that we sell individual bullion bars, the larger bars, to high net worth clients all over the world. And just a few months ago, we started a hedge fund. So that's kind of but they're all the products are based on physical bullion.
Okay, that sounds great. I wanted to ask about an investor's portfolio and what percentage you would say should be in precious metals. And aside from that, how would that percentage best be divided in physical, other products, or even stocks? How does the breakdown look to you?
Most portfolios, if you were to lump things as a generalization, are 60-40 stocks and bonds. They don't have any precious metals. They don't have any REITs. Now, in total, there's 7 asset classes. There's stocks, bonds, cash, commodities, precious metals, and REITs. Another asset class which the Europeans use, which we don't do, is collectibles. So collectibles can be a very good investment, but it's not something you buy from your financial advisor. You have to be an expert in it yourself. So the rest are pretty much all available to buy easily and deal with. So when you look at that, and people always talk about it's good to be diversified and have a balanced portfolio, but they only have 3 asset classes. They typically don't have commodities, real estate, or precious metals. So it's obviously not diversified. And when you have a portfolio, you want assets that are non-correlated to each other. So when one asset is going up, the other one's going down, and vice versa. And that flattens out and improves the return and reduces the risk over the long term. So that's a very fundamental principle that seems to be ignored by many people. It's particularly strange because if you look at what institutions like pension funds, they target for a 6% return, and many of them don't get that. Whereas if you look at precious metals since 2000, the average return in US dollars has been 10%. The average return in every currency around the world is about 11.5%. So gold is clearly outperforming the traditional portfolio. If you look at all the asset classes, the common ones, then REITs are the best performing, and this is over a period of over 20 years, followed by precious metals, then stocks, then bonds, then cash. So it's those arguments that's why you want to hold bullion. Now, I'm asked this question about what percentage of your portfolio. So under normal times, which we're not in right now, it should be between 10 and 20%. At 10 and 20%, it'll improve the overall portfolio returns and reduce the volatility, so you'll do better. But I always look at things is that if you understand, for example, that gold is money, and the pieces of paper in your pocket are just pieces of debt, then I look at it and say, okay, if I start with my money in a vault at 100%, then in order to take the gold out of the vault and put it into an investment, I have to be convinced that I'm going to get more gold back than I put in. And that hasn't worked for the last 20 years. So that when you say, well, what percentage, certainly something like, Apple or Google, it would have been worth taking the gold out of the vault and buying Apple or Google. Most investments, you'd get less gold back than you put in. So it's
Right.
kind
And
of something that people have to really get to understand, to come up with that percentage that suits them.
right. And of course, it is very individual, but I did find it interesting that you are pointing to 10 to 20%. A lot of people that I speak with are usually saying more like 5 to 10%, which is a little bit lower. So it's interesting to hear about that higher percentage that
We've
might work.
actually run the numbers. We've got relatively sophisticated models, and we can put indexes for all the things, and then just try it at 5, 10, 15, 20, whatever. And 20 over the last little while would have been the better kind of conservative number rather than anything else. But for people that really understand what gold is, start with 100.
Well, and speaking about how gold's been doing this year, it's been performing quite well. And I did want to get your take on what's been driving that price activity. Of course, we have the coronavirus that's playing a role. So maybe you could talk about how that fits in and if there are other factors that we should be paying attention to.
Well, what the coronavirus has done is that it's forced the governments and the central banks all around the world to print an enormous amount of money. In the U.S., it's over $3 trillion just during the coronavirus. Now, the thing is, when you're printing that much money, the value of the remaining dollars still in the system is depreciating, and it appears that gold is rising, but it's actually the currency that's falling. And the thing is that right now, that all the money that's being printed was used to pay people not to work. Okay, but sooner or later, when the governments think it's safe and they need the economy back on track and everything working again, then they're going to have to probably print 4 times that amount to give the economy the necessary boost to get attempt to get things back to normal. And there's so many industries, like you take the airline industry, the hotel industry, the entertainment industry. It's going to be a long time before they get anywhere near back to normal, no matter how much money you throw at them. So that's one factor. The second factor is that it looks like it'll be a very contested election. Okay, so no matter who wins, there's probably going to be lots of lawsuits, and there may not be a final decision for weeks or months to come. So that's putting in a lot of uncertainty in terms of the thing. And when you have uncertainty like that, then the gold price tends to go up, the US dollar loses value, and those are kind of those are the big driving factors. Because the Fed has printed so much money, the excess dollars have gone into equity. So after an initial decline of 30%, the Dow, the NASDAQ, the S&P have almost gone back up to normal, or where they started before COVID. But the important thing there is that there's a big divergence between corporate earnings, which have fallen, and the price of the stocks. So the stocks shouldn't be going up, they should be going down. But it's just because of the excess money in the system that they're going up. So that makes it a very vulnerable situation, when it does get, and reverts to a mean sort of thing. We're going to see a dramatic decline in equities, and much of real estate is going to be a problem. Commercial real estate, office, real estate, hotels. Those are going to be areas there that the real problem hasn't hit yet.
Right. And would that be because of the shift to working from home that we've seen in so many industries?
Yeah, it's more and more people. I was speaking to my lawyer today, and they have downtown offices on the 54th floor, and when we were allowed to open, they went back to work and only lasted for about a week because it would take like an hour to get up the elevator. So people aren't putting up with that. But so a lot of people are finding that depends on the kind of work they can effectively do it at home. And then, there's going to be big vacancies in office space, big vacancy in retail plazas. The hotels are all nearly totally vacant right now. So if they're privately owned with mortgages, it can only last so long with no income.
Okay, that does sound like a situation to watch, definitely.
No, that's right. And
Right.
it's got kind of, many vulnerabilities all happening at the same time.
Right. And I wanted to ask, we mentioned you're the author of the book $10,000 Gold. Obviously, you had written that before everything this year was happening. For
Mhm.
those who aren't familiar, can you walk us through how you came up with that figure? And does it relate to the things that we do see going on now?
Well, basically, if you look over, a reasonable back time frame, the price of gold and the total amount of U.S. debt is correlated. So they would go up together. And in 2011, it went out of sync. That U.S. debt kept growing, and now has even grown incrementally. But the gold price corrected a little bit, and now is going up again. So at the time I wrote the book, then I was looking at that over the next few years, the debt would climb to this, and you get $10,000 gold. You also get it that if you take a look at the pension funds alone, and many of them have unfunded liabilities, and there's 300 trillion in pension funds, but there's virtually no pension funds that hold gold. There's only, to my knowledge, 4 in the world. We deal with one here in Canada, the Texas Teachers Pension Fund in Texas, a Dutch pension fund, and a police pension fund. I think it's in Michigan. That's it. But if those pension funds were even to allocate 1% to gold, which isn't much of a push, then you're going to get well beyond the $10,000 because the mine supply is going down. So there's only so much gold available. And when you start trying to buy it up in that kind of volume, you're going to drive the price up. And that's inevitably going to happen because the pension funds many of them were grossly underfunded before COVID. Now with COVID hitting and all the economic implications, many of them own, big shopping centers and big office buildings, and those are going to take a big hit, which they never have before. So there's going to be a shift in thinking that way, and that's where there's been numerous kind of analysts that have now predicted, $20,000, $40,000, $50,000 per ounce. So it's a huge number, no matter which way you look at it.
Right. And interesting, I think a lot of people do mention that the size of the gold market, it's just so small that incremental moves, like you're mentioning about the pension funds, can really create a big effect. And we are hearing more and more about generalist investors coming into the space. Are there any other groups you would anticipate that could also enter and perhaps add to that?
Well, there's everything in terms of traditional mutual funds, or some cases are starting to allocate to bullion, different institutions like insurance companies, endowments, foundations. But right now, like usually the first entities that make the move are high net worth investors, family offices. They're kind of traditionally out of the box thinkers and move into things well ahead of the mainstream. And that's kind of what we're seeing right now. It's not quite a mainstream public kind of investment yet.
Right. Now, that path to a much higher gold price, whether it's 10,000 or even one of those much higher predictions like some people are making, what does that look like to you? Is it a straight up movement? Is there a pullback in there?
Oh, it's
Is there
never
a time
like
period?
that. It's always like we were at past 2000 in, I think it was August, and now it's corrected down to as low as 1800, and it's now back up to 1900. But that's typically the thing. So that what I recommend to people, like that if you decide to get gold, start sort of dollar cost averaging and buy, because to try and time it, we've been looking at this for 20 some odd years, and timing is very, very difficult, and unless that's kind of your job as a bullion dealer or something. But most people won't get the timing right. So just, instead of trying to pick the bottom or the top, just dollar cost average in.
Now, I also want to make sure that we touch on silver because I know our audience also has an interest in that metal. We did see a rise in silver this year, as well as the pullback that we've seen in gold. What do you see happening with silver as we move forward? Do you see the same explosive action as gold? What are your thoughts there?
Well, the silver is dramatically undervalued compared to gold. Like normally the gold silver ratio is about 40 to 1, and now it's been hovering, in excess of 80 to 1. So silver needs to double just to, get normalized to its average. And then as gold is rising, and it needs to keep up there. So that means from today's price, the potential upside in silver is dramatically more than just gold. And to a lot of people too, is like silver is always referred to as poor man's gold. You can buy a silver coin for under $30 for, gold ounce is 2,500. So.
Right. And, like platinum, which you mentioned as well earlier, silver has an industrial side. How does that play into its dynamics?
Well, it's for the industrial applications, which is mainly electronics. There is no substitute. There's nothing else you can use. So it's kind of fixated. And the other thing is that it's what's called it's price and demand inelastic. So for example, in your cell phone, there's a few cents of silver. So if the silver price went from $25 to $200, it's not going to make any difference in the price of your cell phone. So the manufacturer of the cell phone is going to have to pay whatever price that happens. Normally, when the price goes too high on something, then demand falls. But that's not what will happen in silver. The demand will stay the same. There is no choice, and the amount per electronic product is virtually insignificant. Same thing for platinum, and platinum is used in catalytic converters for diesel cars. So if you take the big diesel trucks that are $150,000 to buy the truck, well, there's only a half an ounce of platinum in the catalytic converter. So again, it doesn't make any difference.
Now, as we wrap up, are there any final words of advice that you would offer to investors as we head into the end of the year, which you mentioned is probably going to be a turbulent time, or just in general about how to approach the precious metals market at this time?
Well, what I always say to people, like, you have to, when you make your decision, which isn't in the mainstream, you want to be able to sleep at night. So you're going to have to devote some time to do this, or you're going to suffer some negative financial consequences. But to start with, there is virtually little to worry about if you start at 5–10% and just get started. And then going beyond that, you want to do your homework and do some reading. And that's what I tried to do in the book. It wasn't just about $10,000 gold, but it dealt with the whole history of money and so on.
Okay, well, that's great. Thank you so much for being here today. It was great to hear your thoughts on gold and the other precious metals and what's happening right now.
Great. Well, I'm glad to be here. Thank you.
Once again, I'm Charlotte McLeod with the Investing News Network, and this is Nick Barisheff with BMG Group.